Good afternoon. Thank you for joining us. In the next half hour, we're going to be giving you the September 2021 update. 20 years ago, I wrote an article stating that there were only three things that are important with understanding investments. They are inflation, interest rates, fundamentals of the business. The reason is because inflation affects everything. Interest rates, that affects bond prices, and inflation and interest rates affect price earnings multiples on stocks, what you pay for a company. Today, we are confronting a major problem we want to share with you. That problem is inflation. And the question is inflation transitory, as the Federal Reserve believes, or is it persistent? We believe that some of the inflation that was caused by COVID-19 is transitory. However, there are major forces that are not transitory and indeed are inflationary. Number one, energy transmission from fossil fuels to renewables. This is an important consideration because the use of critical material in renewable energy is going to create a tremendous demand for commodities, all kinds of critical materials. And these critical materials are in short supply because there's been underinvestment for the last 10 or 12 years. And because of that, it'll create the tremendous demand, which there's not enough supply to handle. Plus, it'll increase the prices of everything, which is inflationary. The next problem is the federal deficits and the total federal debt. That is also a situation that is going to contribute to inflation. And then finally, because of all of these factors, you have a loss of confidence in the dollar and a potential drop in the dollar. And that is indeed inflationary, as we will show you later on. So let's start with the first situation, which is the transition from fossil fuels to renewable energy. The electrification of power and transportation markets using renewable resources requires a massive investment in solar panels, windmills, batteries, hydrogen, and many more things. The energy transition is a complete reorientation of the world's power and transportation market. It's huge. What took a century to build is now envisioned to be rebuilt in the next 2 decades. The transition will require enormous demand on commodities, which is going to cause a major bull market in the commodities, which we think will persist for 7 to 8 years, or possibly even longer. That bull market has already started and is about 1.5 years old. Fortunately, offsetting that is the digital revolution creating productivity, and we hope that that will start to offset some of these inflationary pressures. Now, here are the major problems when it comes to switching from fossil fuels to renewable energy. In addition to the cost is our supply chain that will supply us with all the critical materials. Unfortunately, they come from less reliable countries. For example, you can look at this chart and see where all the different materials come from that are used in renewable energy. I'm just going to use a couple of examples off the chart, and you can see that cobalt, the critical element for batteries, major suppliers are the Democratic Republic of Congo, Russia, and Australia. Copper, major element in all electrical areas, is the major suppliers Chile, Peru, and China. Hardly reliable suppliers, and so on and so forth. So you can see that in addition to the fact that the commodities are going to cost more, it's going to cost more to ship them from all these different nations, and we have less reliability than we do when we just use the fossil fuels from the United States. So that is an additional factor that has to be put into the cost. Now, the major problem with this area is the fact that these materials are in such short supply, and it takes 10 to 12 years to build a new mine, that if we're short of any of these material, it's going to take years to be able to create the proper supply to meet the demand, and in the meantime, the prices are going to go up very dramatically. Let me just give you a couple of sources as a point of reference. The International Energy Association says at least 30 times as much lithium, nickel, and other key materials may be required by the electrical car industry by 2040 to meet global climate demands. Another reference that we would like to source is a Dutch government-sponsored study concluded that the Netherlands' green ambitions alone would consume a major supply of global minerals. Exponential growth in global renewable energy production capacity, the study noted, is not possible with present-day technologies and annual metal production. Now, these are two independent sources that show what a dramatic increase in commodities are going to be needed. The final one that we would like to quote is the Finland Geological Society, which does a tremendous study in all of the different sources of energy. They wrote a 500-page report, and here is one of the studies from them. What they're showing, what they said, is that they did not see that it was possible that we would produce enough commodities for these renewable products that are needed before we run out of fossil fuels. So the point I'm trying to make is that cobalt is 140,000 tons production as of 2018. In order to replace the fleet, the 216 fleet, it would take 120 million tons, which means that's 866 years of production at today's level. Lithium, 538 years. Nickel, 53 years. And copper, 9 years. Now remember, it takes 10 to 12 years just to increase the production. So you can see that this is going to be a long transition, a very costly one, and it's going to be inflationary. So the whole critical area of commodities which are needed, and by the way, this is only for the electric car. This doesn't include solar, it doesn't include wind, it doesn't include anything else. So you can see the tremendous demand for these commodities just in the area alone. Now, the next thing I would like to share with you is the concern about the budget, the deficits, and the debt. Now, as you can look at this, this is the U.S. budget. And the U.S. budget started keeping track in the year 1900. So we're looking at 216. If you look at the far right corner, you can see the revenues minus total outlays, and you have total debt. Then you go to 217 minus 65. If you click down to 220, you have a $3 trillion deficit due to the COVID. In 221 this year, we're expected to have another $3 trillion. And then the projected for 2022 is another trillion, 153 million. So these 3 years alone, the last 2 years and one projected, is supposed to rack up $7 trillion of debt. Now, I want you to keep that number in mind as we go to the next chart, because of the fact that it is $7 trillion. Now, this, I'm going to say this twice, this does not include the $1 trillion infrastructure bill or the $3.5 to more $5 trillion they're negotiating today in the Congress. The other thing that is important is the congressional budget has stated that they do not expect the interest rates to be higher than 2023. If indeed they are higher, we're going to show bigger deficits than we're showing on this chart. Matter of fact, we made the calculation at 5% interest rates, which was happening in 2007. And if we had 5% interest rates, the budget deficit in 2022 would be 50% higher. So this is the way we stand today. Now let's look at the next chart, which is your budget, which is the debt that's been accumulated. Now, as I referenced earlier, we started in 1900 keeping the budget. It ran for 105 years. I'm showing it to 205, and we're showing the 206, beginning 206. So you can see that we accumulated $7.5 trillion over 105 years. And in the previous chart, I showed you that over the last 3 years, one going forward, we're accumulating as much debt as we did in the last 105 years. So you can see how significant that is. Now take a look at the next 5 years from 205 or 206 to 211. We accumulated another 4.7 trillion. That took us to 12 trillion. Then at the beginning of 206 to 216, we added another 5.7. That got us to 18 trillion. And now from the beginning 206 through 221, almost 15 years, we accumulated another $9.65 trillion, which gets us up to 2775. We're actually above that. We're actually at about 28 trillion. So we went for 105 years for 7.59 trillion. And now in the last 15 years, we've added the difference, which gets us to 28. That is a compounded rate of 8.9%. What that means is that if we continue at this pace, we will double the debt in 7 or 8 years. Now, the current debt to GDP is 125%. In other words, we owe 125% of what we create in GDP today. That is the highest level we've ever had in this country, including the debt that was racked up because of the Second World War. It's a tremendous amount of debt, as you can see. Over the past 15 years, we have increased the debt 265%. That's 9% compounded. If there's no change in this debt, we're going to double it in the next 8 years. Now, as the deficit increases, it causes a lack of confidence in the U.S. budget, and it creates a decline in the dollar. Just like if you're a good debtor and you have a AAA rating, you get low interest rates, but as your debt increases, your interest rates rise, and that'll happen to the United States dollar, and that could cause a decline in the U.S. dollar, and obviously that is inflationary. Now, I want to refer you to the next slide, which is just an amazing thing, and I would encourage everybody to read this study by the Richmond Federal Reserve. They had the luxury of hindsight. I think it was 1998, they did the study, and they studied the most disastrous inflation in the United States, which was the 70s. And by the way, we started Century Management at 74, and that was right in this inflationary period leading all the way up to 79. And what is amazing is that Arthur Burns was one of the top business cycle study person in the world. He was respected worldwide for the research that he did on business cycles. And in addition to that, he was an inflation hawk, which means he was very much against inflation. The irony of all this is that while he was the top business cycle study, while he was an inflation hawk, he presided over the worst inflation the United States has ever experienced, including the inflation during World War II. And after they did the study and they read all the notes, the debates back and forth, they had the luxury of that. They did this study and they included in the study his speech. And I'm going to read you this speech because this will show you exactly what's going on today and what's going to happen in the future. Here it is. Once it was established that the key function of government was to solve problems and relieve hardships, not only for society at large, but also for troubled industry, regions, occupations, or social group, a great and growing body of problems and hardships became candidates for government solution. The government program's cumulative effect was to impart a strong inflationary bias to the American economy. The pursuit of costly social reforms often went hand in hand with the pursuit of full employment. This weighing of the scales of government policy inevitably gave an inflationary twist to the economy, and so did the expanding role of government regulation. And here's the most important thing he said. My conclusion that it is illusory to expect central banks to put an end to the inflation that now afflicts the industrial commodity. Does not mean that central banks are incapable of stabilizing action. It simply means that their practical capacity for curbing an inflation that is driven by political forces is very limited. And what is so important to understand is here was a man who knew what had to be done, but because of political pressures and other reasons, he was not able to do it. We had a lot more flexibility in the 70s because the discretionary expenses of the government were almost 50% of the mandatory. In other words, that 50% of the budget could be cut in some way. Today, the figures are reversed. Only 1/3 is discretionary, which means they have less to cut, and 2/3 are mandatory. And I want to point out that the government is trying to pass a $1 trillion and a $3.5 and $5 trillion budget on top of this, which will make it almost impossible to cut. So when you have $28 trillion in debt, when you have budget deficits even under good conditions, there is just no way that you're going to be able to pay back this $28 trillion debt and climbing. So how are we ever going to pay it back? I would like to read to you a quote from the federal chairman, previous federal chairman of the Federal Reserve, Mr. Bernanke, in a speech in 2002. He said, "What happens if we have deflation? The US government," I'm quoting, "has a technology called a printing press, or today its electronic equivalent, that allow us to produce as many dollars as it wishes at no cost." So here is the answer that the federal government has, that they can just create money out of thin air, which they've been doing, and they're going to have to do if they pass these budget resolutions that are in Congress right today. And there's only one way to pay that off, and that is by printing money. And I don't need to tell you, because all you have to do is check through history going back from the Romans to the current situation, that whenever you print money, eventually it loses its value, it causes inflation, and then you have to have some serious repercussions to get it under control. So this situation is exactly where we are today, and I just wanted to point that out. Now, in the next chart, I'm going to take a few minutes because we did a study to see what happened during the inflation of the 70s, and you can see the chart with the CPI, the Consumer Price Index, and the core CPI. Now, I want to point out the core CPI is minus food and energy. I don't know too many people who can do without food and energy. So the CPI is probably the higher rates of inflation that you're going to see. Now, in 72, it went from 327 to 341, not too much difference. If you look at the S&P multiple, the second from the right, it was at 19 times earnings. Now we get into 73 and the inflation starts to pick up, and it starts to go from 365 to 871 in 1 year. Look at that. 365 to 871. Look at the PE. It started at 18.9 and ended up 13.7, which is a 26% decline in the price you would pay for the same company a year ago. Now you go another year, 74, the inflation goes from 871 in December 73 to 1234 at the end of 74. The market declined 48%. The PE moved from the 13.7 to the 7.7. So you had a decline from 19.1 to 7.7, a decline in what you pay for a company, and that is a 58% decline. The reason the market didn't decline 58% is because of the fact that the inflation, the companies were able to earn more money, at least the ones in the S&P, and so they increased their earnings, which cushioned the decline. But the main important point to remember is that the price for everything goes down as the inflation and the cost of everything goes up. And that really hits the market, it hits consumers, and it really is devastating. And that's why Arthur Burns was such an inflation hawk. Now, the good news is that offsetting this is the digital revolution. And that has been transformative. In other words, we have made some real progress. I'm only going to read point 4, which is the main thing, is that we're hoping that this the digital revolution will continue, which we think it will, and that'll help cushion the inflation. It also helps increase productivity, but more importantly, it creates tremendous opportunities, and that is in the area of cloud computing, artificial intelligence, supercomputing, robotics, 5G, electric vehicles, autonomous vehicles, virtual reality, precision farming, and many more. We see technology continuing to produce large productivity gains that hopefully will offset the inflationary pressure. And now I would like to review our portfolio so that you get an idea with these thoughts in mind how we are investing your portfolio. And we're going to review the portfolio, and it'll show you the areas that we're invested in. So first of all, we believe interest rates are going to go up irrespective of inflation. And interest rates now are the lowest in almost 150 to 200 years. Matter of fact, the interest rates never got below 3% during the Depression. If there's any time you have lower interest rates than this, it would be during a depression. But this shows you how artificially low the Fed has kept the interest rates to be able to continue this printing of this money. But eventually it's going to have to normalize. Interest rates are going to go up. The banks have been penalized because of low profits, because of low interest rates. They're going to get more profits because the net interest margin should increase. We are invested in 20% in communication and technology sector. These sectors will likely benefit from productive gains as well as having pricing power if we see an increase in inflation. And if inflation stays lower for longer, they'll likely benefit for their very strong growth rates and their tremendous balance sheets. Now, one of the things we've learned by studying inflation, I've studied every major inflation, including foreign inflations, and one of the things we learned is the companies that do the best are the companies that benefit from the increase in the commodity prices and the companies that service those areas, and also the companies that have pricing power and can grow faster than the rate of inflation if they're bought properly. So we have 20% of our portfolios in that section, and they will do well irrespective of whether we have higher or lower inflation. Then we have 20% in energy and materials sector. These sectors should benefit from supply and demand dynamics as well as from higher inflation. These companies have hurt us the past few years because we were early in them, but now they are really helping our portfolio, and we see a lot of potential. The bull market, we feel, is 7 to 8 years. We're in it about a year and a half, so we have a long way to go. And just from a historical standpoint, during the 70s, the areas that did the best, energy went up 300% over the 7 or 8 years, or to put it annually, the energy increased 38% for 7 straight years. Gold went up 36% for the 7 years. And so when you look at the way we're invested, all of these areas will do well if things stay the same, but they will even do better if inflation impacts those areas, because in the energy section, you have a tremendous leverage. The energy companies have been in a bear market for 12 or 13 years, and they are just now starting to get their stride. They are still enormously inexpensive, and so we have many different areas covering the commodity area. We have the energy, materials, industrial sectors that should really help us through this period. The remaining portion of our typical equity portfolio is invested in the industrial, healthcare, consumer sector, plus we hold some cash. And that cash is for the opportunities in any one of these areas that present themselves. In closing, I would like to say that we are going to have enormous opportunities in these areas. However, they're not necessarily going to be in the areas that have done the best in the last 10 years. Some of these areas, like the energy and material sector, have been the worst performing over the last 10 years, but we believe the opportunities are so great that they could be one of the best performing areas over the next 7 to 8 years. So in closing, I would like to say thank you for listening and watching. We want you to know that we are committed to this particular area, and we will continue to rotate the portfolios as opportunities present themselves. Thank you for joining us in this service.